think we all know examples where mom and dad have sold the farm, but of course have no intention of leaving the farm. So maybe they sold everything off other than the home quarter, or maybe they carved out their yard site into an acreage and sold the rest off, but they're staying on the farm. The key to that is that they're not selling the buildings, right? They might have a shop or two, they might have a barn, number of granary bins, and so on, and they haven't sold those assets and they're not intending to, nor do they even need to depreciate them anymore. And so class amalgamation is something that the tax rules allow you to take a series of pools, and this could be your class 10, 8, 6, and whatever else you might have, and bring them all together into a separate pool on their own. What's the value of that? Well, in this instance, so we had 500,000 of taxable income in our class 10 pool. And so class 6, we aren't selling any of those assets. But let's assume that that ending balance in the previous tax year was $100,000. Well, that $100,000 is something now that you can actually use to offset some of that income from the class 6 pool sales. So your 500,000 of taxable income can turn down to 400,000 of taxable income. We've reduced your taxable income by 20% by a simple accounting procedure. That is where working with a financial planner and advisor who can provide that forward-looking tax planning can ensure that those potential tax dollars stay in your pocket versus Revenue Canada.